Greetings everybody, and thanks so much for tuning in to this week's Ask the Advisor show. I'm your host Mike Desepoli from Heritage Financial Advisory Group, and this week in episode 11 we discuss what is a risk profile and why it's important. In today's show I'd like to cover three parts about the risk profile. Number one, what it is. Number two, why it's important that you know what your risk profile is particularly. And number three, how you go about finding out your true risk profile. So first, what is it? A risk profile is a general baseline test that financial advisors and investment professionals use to gauge how much risk or how little risk a client is comfortable taking with their investments. No two clients are created the same, and no two people react to risk in the financial markets in the same way. So it's very important when you're building out a portfolio, if you're working with a financial team, that they're taking you through this risk profile process. This process will include asking you certain questions based around different scenarios that may take place in the financial markets to gauge your reactions to those scenarios. By getting those answers from you, your advisor can tell how you react to certain situations, which will better prepare them to build an investment portfolio that's tailored to you and your individual levels of risk. Nobody wants to have a portfolio that has so much risk prevalent that it keeps them up at night and you can't sleep. That's not a good situation for you, your clients, the advisors, or anybody involved. So any good advisor is going to take you through that risk profile process. The reason it's so important is because many investors out there do not understand the level of risk they take in their portfolio. We have a tendency as investors, as markets climb higher and higher and higher, we take on more and more risk without even realizing it because we're buying the latest hot stock or good investment and we're seeing our money grow. So we really don't pay much attention to just how much risk might be in the portfolio. But it's when the market turns and starts to head south that people start to pay much closer attention and realize that maybe a portfolio they have is a lot riskier than they originally thought and may not be suitable for them. So it's very important to evaluate and establish your risk profile before the market takes a turn south. This way you understand what things may look like if things start to head in the other direction. So how do you find out what your risk profile is? Well, you could start by meeting with an investment professional, a financial advisor, and going through the process with them. Now, for people out there that have a financial advisor already, if you're working with a professional and he's built or she's built a portfolio for you, but you have not gone through this risk profile process, that's a red flag. That's like building a house without a blueprint. Okay, you don't just start nailing studs together. You got to have a plan in place that lays out the framework of how this house goes together. And a portfolio is no different. Anybody who's out there managing money for you without knowing your true risk profile, they're flying blind, and it's a dangerous proposition. Because while the markets have been good for some time now, as soon as things turn, if and when they do, you're going to see risk show up in your portfolio very quickly, and it may be a lot more than you realized was even there in the first place. If you'd like to go through the risk profile process, feel free to reach out to us. We'd be happy to work with you on that. And of course, send us any questions that you have pertaining to anything in the investment community. You can email us info@financialadvisorny.com or send us a tweet using the hashtag AskTheAdvisor. We'd be happy to answer any questions that you have, and we'll get right to it. Thanks for watching. Keep an eye out for next week's show, episode 12.